In our last video titled Understanding Market Volatility, we talked about what a lot of people in the industry call the price of admission. The reality is, if you want to invest, you will experience volatility. It's just part of the deal. Here's an analogy someone once told me many years ago as a business coach. And what they told me was, if you like playing basketball, but you don't like being pushed or even shoved around, then don't play basketball. The same could be true for investing. Investing works the same way. If you want long-term rewards, you have to be willing to accept short-term discomfort. This video is a natural extension of what we talked about in the last video, but we're going to cover what to actually do and how to approach a market correction. Almost like a checklist or a blueprint. What I'm trying to do here is just give you something that you could always come back to help ease your mind in terms of best practices and how to navigate through a market correction. I even will use it myself because it's a good reminder. And sometimes when a market correction happens, it's hard to be in that sort of frame of mind. And stick around to the end because I'm going to give you some surprising data that might give you a whole new perspective on market recoveries. So let's get into it. Number one, corrections are normal. Don't panic. We touched upon this in the last video. So let's put some data behind it. We know that the market will correct of at least 5% on average 3 times a year. 10% corrections happen every 18 to 24 months. 15% declines happen every 2 to 3 years. And 20% bear markets happen every 6 years. These numbers, again, they're not abnormal. They're part of the market's natural rhythm. But I know that what happens is that when people do start seeing a correction, a lot of times people start freaking out. I get a lot of calls, hey, what's happening? This, that, and the other thing. And a lot of times it's just the natural way that the market will flow. Number two, step away from the screen. Get off social media, turn off the TV. Don't read any sort of market news that's online. Even maybe stay off YouTube. Avoid the urge to watch the market every single hour. It's very tempting. When a correction is happening, you tend to want to watch the news and see what's going on and listen to every analyst that's out there. So that way you can maybe make yourself feel comfortable or even what to do with inside of your portfolio. But history and statistics show that a lot of the worst decisions that you can make from an investing standpoint often happen right before recoveries begin. Just look at March 2020. You can even look at what happened in the beginning of April 2025. We're recording this in the first week of May of 2025, as I alluded to before. Instead, go out, take a walk, talk with some friends, go see a movie, go exercise. Just get away from the market news and any sort of red that you might see with inside your portfolio, your app, or online. Number three, accept that it could get worse, and it's okay. So corrections often deepen into bear markets. That's just part of the cycle. But this is where solid financial planning comes into play, including having short-term reserves, almost like an emergency fund. I know I talk about that a lot with my clients, having something that's in safe assets, basically, having a portfolio, which we'll get to in a little bit, that's diversified. These are all steps that you can take so that way you're already prepared and you don't have to really have a panic attack. And most importantly, remember this, that history tells us that recoveries do happen. More on that shortly. Number four, reassess your risk tolerance. So if a 10% drop leaves you feeling panicked, it may mean that your portfolio is way too risky or it's not at your true comfort level. Most people, what happens is that when a bull market happens, they overestimate their risk tolerance and they underestimate it in bear markets. Internally, we use something called nitrogen wealth, which basically will assign a risk number to your portfolio and actually compare it with your comfort zone or risk threshold. It's not all about what you answer on a risk questionnaire. It's about how your portfolio behaves when things get tough. Number five, and we talked about this earlier, but be truly diversified. So in recent years, what I've seen is that diversification almost seemed like a negative word, especially when large cap and tech stocks were just crushing it. But what's happened here in 2025 is that it's reminded us that diversification actually works. International stocks, value stocks, and even some alternative products have basically reemerged. And really, institutions have never stopped being diversified as well. Diversification, it's important to understand this. Diversification doesn't guarantee gains, but it helps the risk of being concentrated in what's suddenly out of favor. I know this was a common question that came up with current clients as we were going through this correction. What I said to a lot of people was, you know what, we did a lot of heavy lifting up front. We had a diversified portfolio across different asset classes. So you're in good shape. And the numbers prove that out. Number 6, rebalance your portfolio. Rebalancing helps you buy low and even maybe sell high. And that's done by design. A disciplined rebalance strategy will just help you reallocate to maybe asset classes that you drifted away from, and maybe even take some profits off the table for you as well that you didn't realize you had. I'll give you an example. Investors who in March of 2020 went into a 60-40 portfolio saw meaningful gains during or the rebound. A lot of times what happens is we'll see clients often wait for the calendar year to flip over before they actually start doing a rebalance. And when you think about rebalancing, don't be so married to the calendar. You can do a rebalance at any point in the year, but a correction is a really good point where you can then go in and just move things around a little bit. Number 7, understand that corrections often lead to recoveries. And here's where things start getting really interesting. It might feel like downturns will last forever, and they do. When you're going through it, it sucks. It really doesn't feel well, not only for you, but also for us as advisors. It's just not a fun time. You're constantly running around seeking answers, jumping on different webinars with different managers to understand how they're seeing things and trying to answer client questions because there's panic that's setting in and people are looking for answers as to what to do. But the data tells a very different story. Markets often recover faster than we expect. The sharper the drop, the stronger the bounce, especially when you get a cause that takes a little bit of time to sort of settle in, like inflation numbers or interest rates or geopolitical shock. Before those things begin to stabilize. And so this dovetails into also another question that comes up, which is, can you actually time the market? And the answer is unequivocally no. I could tell you countless examples just in our day-to-day actions when managing client portfolios of how market timing, yeah, you might get it right once in a while, but more often than not, you will miss it by a mile. It's just impossible and it's too dangerous to try, especially if you have a long-term outlook. If it's short-term, then that's a totally different story. But here's the interesting data that I was talking about. Since 1948, there's been 48 market corrections of between 10 and 20%. On average, 1 year later, the market was up 19%. There were 9 times that it fell between 20 and 30%. And 1 year later, it bounced back by an average of 35%. 3 times the market fell between 30 and 40% and came back 47% 1 year later. And 4 times the market fell more than 40% and it was up 49% 1 year after. So let that sink in. Again, I understand when you're going through a market correction, it feels like things will never get better. But have that as a reminder. And that's information that we got from our chief investment officer through Osaic Wealth. Sandra Smith, we're an independent firm, but we're on the Osaic Wealth platform, from Phil Blancato, who mentioned that in a podcast that I listen to routinely every single week. And he mentioned those numbers. And, I just thought they really resonated with me, and hopefully it resonates with you. So some final thoughts. Pullbacks happen. Bear markets happen. That's just how investing works. But even though we know this intellectually, when you're going through it, it's very difficult emotionally. And I get it. I wouldn't say I get calls from every single client when something like this happens, but I definitely hear from a handful of people. And I look to reach out to people to give them some of the information that we're hearing from the data that we're pulling, conversations that we're having with other managers. But I understand that we understand that it's tough emotionally. And it's even tough for us as advisors to go through, as I mentioned before. But when these downturns happen and the headlines turn negative and all of the news that's on TV or on social media is very negative, don't let it cause you to sell at the wrong time. I mean, there's plenty of studies that are out there that will show you how you can really erode your returns by pulling out of the market and not being invested when you do get a bounce back. I mean, we saw that in the beginning of April of 2025, where the market pulled back, call it 10, 12%. And then the next day it had one of the biggest bounces in history. And that happened at 1 o'clock, 2 o'clock in the afternoon on like a Thursday. So when markets are up, people always ask, hey, am I missing out? And when it's down, people say, hey, should I get out? The right answer in both cases is really the same. It's to stick to your plan, especially if it's a long-term one. Stay invested. So next time the market turns volatile, come back to this video as well as the last one, which I'm linking right here, and use this as a reminder or a blueprint to just stay the course. So if you like this video and you found it helpful, please hit the like button. It really helps our channel grow and get feedback as to what are interesting topics for you all to hear and for us to cover. And also subscribe for any sort of upcoming content that we will be releasing, so that way you can stay just attuned as far as what we're hearing and seeing, and how to look at things from our perspective as well as from a typical client's perspective. And with all that being said, we'll see you in the next one.
If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.